What happened to Palo Alto Networks?
I thought cybersecurity was going to be completely safe from all of this AI disruption. Apparently, it's getting thrown out with all of the overpriced, overhyped SaaS stocks.
Are investors throwing the baby out with the bathwater? Let's find out.
What the heck happened? Is the SaaS apocalypse coming for Palo Alto Networks too? We're getting hammered here.
First, we'll show you a very familiar slide of the cybersecurity industry. In 2025, around $215 billion was spent on cybersecurity. The expected annual growth around 12% over the next 5 to 7 years. This is why we talk so much about cybersecurity. This is a secular growth trend in our belief. And Palo Alto primarily focuses on the two biggest portions of the cybersecurity industry, network security and cloud security, but they have made so many acquisitions moving to the right, expanding their offerings in the last 8 years.
When we get to the cybersecurity industry refresh that we first did almost 2 years ago, there's a little footnote here under cybersecurity industry, excluding integrators and reseller services. We're going to talk about that layer of the cybersecurity industry a little bit more because we haven't before. But when we're talking about that total addressable market of 215 billion last year, it's probably headed to somewhere around 250 billion this year, 300, 350 over the next 2 years or so. We're talking about the companies that provide the technology itself and the software versus companies that resell it or that integrate it, sort of like a consultancy firm like IBM or maybe an Accenture, companies like that, which also harbor an important part of this industry. But let's talk a bit more about the secular growth trend, because this was a natural segue early on when we started Chipstock Investor. Cybersecurity, it is very closely tied with the infrastructure. And especially now when you deploy infrastructure, it is in some way going to be connected to everything else. If not to the internet directly, it's going to be connected to a private network. And even that private network may have vulnerabilities that expose it to the outside world. Very different from a couple of decades ago when just a simple firewall around an office building where you had your PCs and your employees using the PCs sat. So this is a secular trend embedded with the infrastructure build out itself with semiconductors. All of it needs to be secured. A lot is changing all of a sudden because of AI. And so cybersecurity, as it tends to be, very fast moving industry. And that causes some real serious headaches for investors. This is notoriously a part of the tech industry where you can very quickly make a lot of money and then also very quickly lose that money as a result of this fast moving nature of cyber market.
So let's focus especially on Palo Alto and take a little walk down memory lane. This is revenues for Palo Alto on a trailing 12-month basis. In orange, total revenues, free cash flow per share, the blue line. Nikesh Aurora, who is the CEO currently, he took over in June 2018. And we'll show you in just a moment how many acquisitions have been made since June of 2018. And that continued until the end of 2023. And then there was this pause. And now we're restarting.
We are definitely restarting the acquisition spree at Palo Alto Networks. This is an important slide, though, because this is a company that has bucked the trend of kind of boom-bust cybersecurity companies. They and Fortinet have been around since mid-2000s, let's say, when pretty simple, in today's terms, network security was more than sufficient. And in spite of all the myriad of changes that have taken place since then, the revenue growth rate has been pretty consistent. They've managed to find ways to evolve and change. But take a note, that middle bar there, the fiscal year ends in July of every year. When Aurora took over in mid-2018, you see the revenue continued to grow, but notice the free cash flow per share line takes a dip for 2 years after that, when the heavy acquisition spree got kicked off when he came in and started to heavily change Palo Alto Networks and that image of it being just a network security provider. Here's the acquisitions since Nikesh Aurora took over June of 2018. We invested initially in Palo Alto Networks when Nikesh Aurora took over in mid-2018. And since then, We've basically kept track of the acquisitions made, money spent. Interestingly, Palo Alto Networks, I'm pretty sure, saw one of the times that we published this table, and now they actually do it too, which is fantastic. There's accountability. Directly on their website, you can actually find a very similar timeline and chart showing the acquisitions they've made and money spent. So they're not trying to hide these, but 31 billion in total spent in cash and new stock issuance, coming up on 8 years now under Aurora's tenure. Pretty crazy stuff. And you can see the deal size getting progressively bigger as time goes on, culminating with CyberArk, the CyberArk deal closing just a few weeks ago.
So what are they trying to do? They're
Yeah.
trying to create the Broadcom of cybersecurity.
Or the Berkshire Hathaway of cyber. Hopefully that is an analogy that holds true. You can see the problem, though, in this chart. This is revenue and free cash flow per share, but on a quarterly basis. The revenue CAGR was fantastic. From 2021 to end of 2024, revenue grew well over 20%. And mind you, when the pace of the acquisitions, as Casey said earlier, started to slow down again and even paused at the end of 2023. As those investments, those acquisitions they made started to pay off, free cash flow per share started to ramp higher. But then over the last 1 or 2 years, the pace of revenue growth has actually slowed. And as they've started to make more investments again, the free cash flow has slowed as well. And in fact, free cash flow per share, not the adjusted free cash flow that Palo Alto Networks provides for a little extra clarity, actually declined year over year in this latest quarter, down 25%. Some of that is from headquarters build out and other one-time CapEx spend, probably on computing hardware and whatnot. So this is the problem. The name of the game has changed once again, as it has multiple times now over the last couple of decades. And so this dictates changes that need to be made in Palo Alto's approach if they want to keep pace with the times and not become like your next gen digital, which still focuses on consumer protection and now money management, apparently, with the MoneyLion acquisition. So they're making big acquisitions. Where's that going to come from? Investments can come from two places, right? You can pay for them with cash, or you can pay for them with
Stock, shares. And that's exactly what's been happening here with Palo Alto. This dates back to January 2021. You can see the increasing amount of shares, not a ton, but definitely significant from 2021. 711 million January 2026. It's actually going to increase between 768 and 773 million by the end of their fiscal year, which ends in the summertime, which will then reflect the cyber acquisition. So in the last 5 years, a couple 100 million shares will have been extended.
Mm-hmm. For a traditional value investor, this is going to be very problematic, right? You're probably listening to this and thinking, this is the last thing you want to see from a company that is supposed to be maturing. You want the share count to shrink. But if you want to invest in cybersecurity, this is going to challenge old preconceived notions. And to be completely fair, it may not work out. But when they decide to issue stock to purchase these assets, the question then has to become, okay, what's going to be the future payoff on a free cash flow per share basis? Because that's what's actually happening here, is the issuance of stock to purchase assets. And that's okay as long as free cash flow on a per share basis continues to rise over time.
The other way they can fund these acquisitions, as you mentioned, is cash. So let's take a look at their balance sheet. And it almost looks like Palo Alto has been readying itself for this ramp up in acquisitions. In red, total cash and cash equivalents. In blue, long-term investments. And then orange is long-term debt, which they paid off in 2024. Just have been adding cash to the balance sheet.
They're in actually a pretty good position to make these deals happen. The debt, obviously, that was to raise the cash to make some of the purchases in years past, was actually convertible debt. And so when they actually paid that debt off early, it was essentially like reducing future shares outstanding versus allowing the debt to convert to stock. So it was a stock buyback in a way. But at any rate, you can see the ballooning assets on the balance sheet, cash and short-term debt. And so back to the point about free cash flow per share, how do we decide when a company like this is a good value or not? This is the stock price in light orange versus the repayments of long-term debt in the red bars and repurchased common stock. Earlier, back in 2020, 2021, even a bit there in early to mid 2024, they actually did make some stock purchases to keep the share count decreasing at some points in time. But then they flipped in the last few years to paying off that debt, getting that repaid. It would be really telling if at some point now, what has become an all-out downturn for the stock and many other stocks as well in cybersecurity, it would be really telling if management decided to fire up a share repurchase program again versus just letting the share count float higher. That would be one way to get a handle on if the stock is a value. What does management think? Because they're very strategic about this in how they choose to utilize capital to expand the business. Okay, now on to the guidance.
This was the previous quarter's guidance, Q2 for fiscal year 2026. This was before finishing up CyberArk's acquisition. So expected 28% year over year for the quarter, and for fiscal year 2026, 26 to 27% year over year for their ARR. And if you drop down just a couple of lines to their total revenue, mid-teens in both of those metrics. Now that CyberArk acquisition has been completed, ARR 56% year over year on the quarter, and then for the fiscal year, 53 to 54%. And then total revenue jumps up quite a bit, 28 to 29% year over year for Q3 fiscal year 2026, and then 22 to 23% year over year for fiscal year 2026. So that additional 8-9% is coming from CyberArk.
Yeah, which is what everybody expected. But it seems that everybody was expecting something more than this. And especially not just the revenue guidance, but also the profitability payoff. It seems that the market is coming to terms with maybe this being a little bit longer of a payoff cycle, maybe akin to like what happened in 2018, 2019, 2020, when the first round of big acquisitions took place. We took some notes here on some updated assumptions from this on the full fiscal year guidance. Basically, it implies about $800 million in additional revenue from the acquisition, most of it from CyberArk, Chronosphere, the observability software. Not much revenue happening there yet. That's a new product launch for Palo Alto, which we already covered before. So CyberArk, their full year revenue actually was $1.36 billion for full year 2025. They just had a simple press release on this. ARR was annual recurring revenue was $1.44 billion, growing at a 23% pace exiting 2025. So that's actually pretty good. Identity is going to be a good add-on for Palo Alto here. And it seems, at least for the next 6 months, the next 2 quarters, the guidance does hold that CyberArk will probably continue growing at an over 20% pace. But because of this updated guide that Casey just showed on the previous slide, it does imply that the existing Palo Alto Networks business might be decelerating a bit. So that's not what investors wanted to see. Also, in tandem with that, perhaps a bit slower revenue growth than what was expected. Free cash flow margin expected to drop to about 37% this fiscal year and probably into the early parts of fiscal year 2027 before jumping back towards that 40% or higher free cash flow margin target next fiscal year and into calendar year 2027.
So there's been some bad news, or at least investors feel like this is all bad news. So let's run through one possible scenario that has the stock price at 152. Free cash flow, 11.3 billion, revenue times 0.37. Total shares outstanding expanding to 773 million. Used a custom weight, $5.41 for this, growth rate of 8% over the course of the next 5 years, and then a terminal growth rate of 6%, discount rate of 10% gets us to what the stock price is currently at, or around there.
We actually are using full year fiscal 2026 outlook for free cash flow per share as our starting point. So this is for the period that will end in July, 5 months from now, using the guidance that Palo Alto provided us. This is a nice thing for all of the flack that the cybersecurity industry gets. Palo Alto is actually, in our opinion, quite transparent about this so that you can track the profitability metrics and make sure that you as a shareholder are continuing to get rewarded, even though there's all that new stock issuance going on to make these acquisitions. So that's the scenario that we used to get to the fair value today. Could be a pretty low bar. Or maybe you look at this and think that's, given how much dilution continues to happen right now, maybe it's still too high of a bar. AI is too disruptive. Palo Alto is going to have to make a lot more investments than they have already, more acquisitions to get up to speed. There's the newest one that they announced to acquire Koi for AI agent security. Huge problem for companies that want to deploy AI agents. How do you keep them secure? Maybe lots of more acquisitions are coming as a result. And so you may think, no way, the stock needs to come down another 10, 20, 30%, maybe more before I'm remotely interested. It's going to depend on you and your comfort level with the operating model and how they fund their expansion via cash, sometimes taking out debt to raise that cash to make acquisitions, and also the issuance of stock. This is the nature of the cybersecurity industry, and it is not for the faint of heart.